Hey, everybody, welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to talk about the 6 best ways to measure your financial health. And these are the numbers that tell you the most about your finances. When you've been working out financially and putting good money habits into practice, it's normal to want to measure how well you're doing. It's similar, and just like you track your progress at work or at the gym, you'll also want to see that you're making improvements financially as well. The challenge is to know which methods can accurately measure your financial health. After all, many of the markers we associate with success don't necessarily signify that a person is doing well with money. A high salary means little if you're spending every penny, and a luxurious house doesn't mean much if you can barely pay the bills. But if you know which metrics to check and how to use them, you'll get a clear picture of your financial situation. So the first one, which we talked about last week, was net worth. Your net worth is the value of all your assets minus all your liabilities. For example, let's say you have 20,000 in your bank accounts, 50,000 in your retirement fund, and a $200,000 house. You owe 30,000 in loans and 150,000 on your mortgage. If you use those numbers alone, you'd have a net worth of 90,000. This is one of my favorite financial items to track because it's easy to understand and easy to use. When your net worth goes up, that's a good sign. When it goes down, that may be a cause of concern. Net worth does have a blind spot in that it doesn't account for the type of assets you hold. If you imagine you're 40 with a net worth of $1 million, you might think you're doing well. But if that includes an $800,000 home and a $100,000 car, it may be deceptive. You have 10% of your net worth in a car that will likely depreciate in value, and you're way off track with your retirement savings. So you have to be careful when using net worth that using it as a measure alone is helpful, but it's not going to tell you the whole story necessarily. I have lots of clients who have real estate in their portfolios, and they come to me being very happy about their net worth, but realizing they still can't retire today because their real estate isn't providing them enough money, rental income to replace their earned money. So you have to look at what kind of exit plan do you need? Are you going to stay in that $100,000 home? Or are you going to sell it and use some of those proceeds for retirement? So net worth is a very good marker, but again, you don't want to use that alone. The next thing to look at is your savings rate. The portion of your income that you save every month is your savings rate. So for example, if your monthly income is $4,000 and you save $1,000 of it, then you have a savings rate of 25%. You can calculate this either using your gross or net income, but using your gross income may be simpler if you have pre-tax deductions, such as a 401k contribution. A common recommendation is to save at least 20% of your income. Of course, if you can save more, that's even better. I recommend a minimum of 25%, especially to my business owners and entrepreneurs, to help ensure they're on track for a healthy retirement nest egg, especially if they didn't begin saving when they were in their younger years or their business was just starting. The one thing to remember is that you don't want to ruin your quality of life in pursuit of the highest possible savings rate. Some consumers, especially those who want to retire early, have made themselves miserable trying to save well over 50% of their income. Instead, you want to find a balance with a reasonable savings rate that also allows you to enjoy yourself in the present, as well as save for a healthy financial future. The next area to look at is your debt to income ratio. To get your debt to income ratio, or your DTI ratio, you take all of your monthly debt payments and divide them by your gross income. This is a metric that lenders will usually check whenever you apply for a loan or line of credit. A good rule of thumb is that your debt is manageable if your DTI ratio is 30% or under. There are a couple of extra considerations to keep in mind when you look at your DTI ratio. First, your types of debt matter. A DTI ratio of 25% is excellent if it includes your mortgage, but it's poor if it's entirely made up of credit card debt. And next, although your DTI ratio uses your monthly payment amounts, the total amount of each debt is also important. Debts with low monthly payments can end up costing you a lot of money because of the amount of interest they accrue. Next, you definitely want to keep your credit score in check. And your credit score is a rating that the national credit agencies of your the national credit agencies of your credit worthiness. And unlike the rest of the items on this list, it's not something that you can actually calculate yourself. In fact, you have quite a few different credit scores under two different scoring systems. We have the FICO that most people know, and also something called Vantage Score. Of the two systems, the FICO score is the most widely used by lenders. Fortunately, there are plenty of free credit score tools online to check both your FICO score and your Vantage score. When you check your score, you'll also see what range it falls under. The standard ranges are bad, fair, good, and excellent. A credit score is far from a perfect gauge, though, of your financial health, but it does demonstrate how well you are at using credit. And since it will be checked for any credit card or loan application you make, it's worth keeping an eye on. You should do this at least annually as well. Even if you have a really good credit score, you want to get your free report at least once a year. There's 3 credit agencies under the FICO system, so you can actually get a free report from them every trimester or so, and just make sure that everything on your credit report is accurate. If it's not, then you can make a plan to get those things corrected. The next, number 5, is looking at your retirement fund. Your retirement fund is a good indicator of how prepared you are for the future. There are 2 popular ways to measure your progress on your own here. The first is to use any number of retirement calculators. You plug in some information about your financial situation, including your age, income, and desired retirement age, and the calculator determines how much you'll need to save both in total and per month to retire on time, given those parameters. The second is to simply compare your current retirement savings to how much you should have saved at a certain age. Recommendations like these are typically multiples of your income instead of a fixed dollar amount. For example, many experts recommend you have 1 year's salary saved for retirement by the time you're 30 to 35. Both of the above calculations are good to use as a rule of thumb. With that said, nothing replaces a good financial plan that takes into consideration your individual financial situation and financial needs. Part of this is making sure to update the plan at least annually to adjust for any changes in your financial world. The last area to look at is your income. Now, income isn't everything, but it certainly has a major impact on your quality of life. What you should look at with your income is whether it's been growing each year by at least 3 to 5%. Any less, and you're not keeping up with inflation. While there may be some down or stagnant years depending on life circumstances, for the most part, you should be making more money as you gain more skills and experience. Now, for my entrepreneurs as well, you want to make sure that you're increasing your income as your business revenue increases so that you can then use that money for your personal wealth side of the equation. A lot of business owners keep most of their money in their business. And so if we look at diversification, we're also looking at how are you bridging that gap between your business revenue and your personal wealth. If all of your wealth is in your business, then you may be in danger of having a bad year, business year, and not having the money on your personal side to keep you on track and keep your lifestyle in check. So putting it all together to get the most accurate idea of your financial health, you need to combine the metrics on this list. There's no single number that can tell you everything, but when you put multiple measurements together, you'll see where you're doing well as looking at where you can improve. And don't forget, take advantage of our complimentary consultation to get started on or improve your path to a healthier financial future. Happy Friday, everyone. Thanks for joining us, and we'll see you next week on Friday's Focus on Finances.